Good morning, it's Jeffrey Cohen, Chicago Quantum. I'm the president of U.S. Advanced Computing Infrastructures, Inc., an Illinois registered investment advisor. And we're here to talk today about a paper traded managed accounts or hedge fund that we're setting up and we're paper trading. And we're, just to give you the net, the fund made a lot of money this week during what was a pretty rough week. And we think we're getting really close to the set of processes and procedures that we'll follow to, to update the fund, to make the transactions. It's an everyday fund. It requires running our Chicago Quantum Net Score model, which you can buy, by the way, for $750 a run for the up run and $750 a run for the down run. If you ran it each day, you'd have enough information to be able to make the trades. And so, trust me, I'd be happy if you wanted to do it that way, or over time, as we become discretionary and we allow you to invest directly into the fund through our custodian, which will be Charles Schwab, then you don't have to pay the $1,500 a day. You just put the money in and you share the benefits, you share the profits. And so, pretty excited about that. And I'm going to share a lot today, but I want to start off with something psychological, and this was very important. So this morning I woke up, and yesterday, Federal Reserve Bank, Federal Open Market Committee, watched the press release and looked at the data, and looked at the way my personal stocks have been doing, and just war in Russia and all this stuff. And I just thought, you know what? This morning, I wasn't feeling it. Yeah, I went to bed super early last night, 9:30 at night. Woke up at 5:40, felt physically fine, but emotionally just drained. Like, I thought maybe something terrible was going to happen in the markets. And I really just wanted to, back off. I just wasn't feeling it. So I went on Twitter. I felt a little bit better. Some of the people that I follow, other money managers, they were also feeling terrible. They were feeling horrible, right? I'm looking, stocks are down pre-market. Stocks I like, stocks that I think are undervalued. And then I saw one good piece of news, but so by now, I'm wasting time that I need to make the trades, to set it all up, right? And I've got time to do it, but that window is closing. And so what happened was, I'm going through stuff, and let's see if I can find it. I probably won't find it, but it's okay. So, net, I read this article. I'm not going to pump any stocks, just don't worry about it. We're good. But what I will say is this, I created a bit.ly of the link. I felt really good about this thing that I read. And I thought, all right, maybe things will be a little better. So I created a little bit.ly link. I threw it out on YouTube. Not YouTube. I threw it out on Twitter. And what's interesting is I'm not pumping a stock or anything. I just said, you know what? New research and data on an oral anti-obesity treatment that's preclinical. And then I felt a little better. I'm like, all right, I got this, right? You look at the analytics, like 66 people saw it, no one liked it, no one cares, right? Let's take a look. There it is, pops up. It's a conference that a company that I follow is doing today. A guy named Marshall Morningstar, who I don't know. I know Rachel Blake, but I don't know Marshall Morningstar. And so, kind of cool. If I were you, I would just grab it, throw it to your desktop, take a look. It's interesting. It's preclinical, so it's really early. But so I'm feeling a little better. I'm like, I feel better, right? But I still realize the stock market's probably going to crash because they're raising interest rates. It's crazy war, nuclear war being threatened, and now we're making peace with China, and you know what's coming, right? We're going to make peace with Iran and all this crazy stuff going on. So truthfully, I don't like any of it. So what do I do? Well, first thing I do is I get to work, right? Chicago Quantum net score, smart volatility. I get to work. And so what does it actually mean? What do we actually do in the morning, right? So the first thing we do is we look at the stocks that are picked by our model. So this is the down run. Boom, make it huge, right? So there were 449 tickers of stocks that are US listed, lots of liquidity, lose money. It's a good place to start if you're looking for a short, you should lose money. Now, if you look at the all-stock variance of these stocks, it is very, very, very volatile. Okay, so just losing money makes you volatile. 3 to 4 times more volatile than companies that make money. So volatility, yeah, I'm going to short highly volatile stocks that lose money, and that might actually even not be U.S. companies. We don't pull the non-U.S. companies out of our dog list. And so, you look, and a lot of biotech, we don't trade the biotechs. Thanks to a client of ours who's very wise. A moment just to recognize the wisdom of our client. Very wise. So, we look at AMC. Oh, a movie company. I like movies. Everbridge, software company. Far be it for me to look at them and decide, but whatever. Snap, another kind of software e-commerce company. Peloton Interactive is the fourth. So we only do 3, but Peloton is right there in the list, right? It's right, oh, we're so close. And then you got IonQ, and then Tellurian, and then GameStop, and then DraftKings, and then ForgeRock, and then Roblox. So lots of, oh my God, Tenneco, and they're actually headquartered right here in Highland Park. Oh, that's not helpful. I know, and Canopy Growth, which is a cannabis, Teladoc Health, lots of stuff, right? But still lots of pharma. Pharma is really dangerous. So if you've got extra money, pharma's great because you're going to lose your shirt, you're going to make your shirt. Who knows what you're going to do, but you can make it big, but these are risky. So going back to it, we ran our model, and out pops AMC, Everbridge, and Snap. So those are our 3 shorts. Could have shorted Peloton, but actually I think we sold it yesterday. And so, yeah, so that's the... Now, what about the up... Oh, we'll save it. That's fine. What about the up run, Jeffrey? Got any good stocks in there? I love showing this to you. You could have bought the run. You would have had it first thing this morning, 5 a.m. You would have been like, oh, there's some good data in there. Every stock, oh, love it. Betas and model portfolios and you name it. Kurtosis and skew and stocks that have lots of volume, stocks that have no volume, and stocks that have gone up a lot, and stocks that have gone down a lot. And you would have had all this data. You'd have been like, oh, loving it. I love this, right? I live for this. I mean, I actually made the model for myself, but I open it up to clients, and if you want it, I'd love to sell it to you every day. Wrap it up. I could probably do a direct billing. We could do like electronic payments. You name it. We're fine. So what I notice is the S&P 500 variance has not risen in the last few days. So although the market feels terrible, it's actually settling down. That's interesting. That's very interesting. The all-stock variance, the variance of money-making stocks has settled down. It's still really high. Settled down. It's all right. There are 1,556 stocks that have really good liquidity, U.S. listed, U.S. domiciled, with all the right data validation, stock price, volume, you name it. That's a lot. Actually, there's more stocks that are profitable that are making our list. And then we ran additional solvers because we felt bad about the market, and so we added a lot of horsepower. And so, as we expected, The model wanted us to go from 17 up to 21 stocks, and we lost 4 ticks of edge. So first off, I hate losing ticks of edge, especially when I tell my server to run really hard. And I also don't want to take the cash from the fund and put it in the market. No, I want to keep it in cash. Cash is king, right? Wrap it up. And the other problem is that I had to dollar cost average down some of the holdings because they were not even. See, all the stocks have to be held to an even amount, and when stocks fall, you kind of have to buy more to bring them up to the same level. So every day you start off the day, every stock is roughly at the same value. So lots of money got spent today, and that's what made me uncomfortable, was the idea that in what should be a very crappy market, I'm going to be adding to the longs. The good news is I'm adding to the longs of what are pretty high quality companies when they've gone down in price. So that's helpful, right? Like, I'm getting the discount. So that's good. And then what I did at the end of the run is I went back and I ran, it's not in this one. That's okay. It's in the other, it's on the server. But I went back and I reran some of the solvers to see if I could get any more edge this morning. No. Couldn't find a better portfolio. So 21 stocks. So then we have to go in and we have to note what we're doing here, right? So if it's dark green, it's a buy. Buy Aries. We just sold Aries. Got to buy it again. Buy CC, Chemours. It's an interesting company. I don't really know it that well, but it's fine. Meta, buy Meta, which is Facebook. Buy State Street. So it wanted me to take a break off of State Street while it dropped a few bucks, and then we bought it back. All right, that's cool. The model was pretty smart. It said, get out of State Street. There's bad shit happening with the data. I find this hilarious that the model knows. So what's interesting is our model tells us what to buy and what to sell every day. And it does it based on historical trading patterns. And in fact, it had us buy Tesla. So what happens is we end up selling these stocks when it tells us to a little higher, and we buy them back a little lower, and that just makes a little more profit in our model. Like, we were holding State Street forever at like 75, 77. It's at 68 and wanted us to buy it back. That's fine. Made like $10 waiting, right? So, and you just keep going on with this. So what we do is we update all the prices pre-market. And that tells us, roughly speaking, how many shares we should hold. And then we go in, and as we buy them, we then have outlays that the model made. And so we had to spend $4,950 on new stocks today. So $5,000. $5,000. You go to the S&P 500, and we kept having to update the pre-market of the S&P 500. And in fact, I'm going to put a little plug-in to NASDAQ Book Viewer. Because NASDAQ Book Viewer gives us a very timely data feed. So right now, it's at 374.94, 374.89. You know, if I were to go to Yahoo Finance, especially pre-market, or CoiFin, especially pre-market, I would see data that was 20 to 40 minutes old. And in general, there's like a bias that it shows you when the stock price is higher, it doesn't show you when the stock is lower. So, very interesting. So, you got the S&P 500, you needed to hold 50 or 89. See, we're actually running 3 hedges, and over time we're seeing which hedging strategy makes the most sense. Right now it's between the CQNS down run as a hedge and our beta weighted S&P 500. Now we calculate the betas precisely, so we had to go through that again today and check every beta. And the betas are coming down. So what's happening is stocks are decoupling from the S&P 500. So what's happening is big bets are being made on the S&P, and then the stocks are being, the arbitrage is being worked out. The stocks are being adjusted towards the S&P, but it's not 100%. So Yeah, it's been interesting. So our beta weighting went from 181 to 176. So that's cool. So it wanted us to have 89 shares short of the S&P 500 index. So that's 21 shares at 376.79. That's an actual buy price. And that's almost $8,000. So it wanted us to buy 5,000 in stock, but short 8,000 in index. Now, you go back to the stocks we talked about, which is AMC, EVBG, and Snap. And we had the prices in there. We did the pre-market. Then we did just as it opened. And yeah, here's how many shares. We actually had to dollar cost average and boost up our shorts by another 51.21. So what's happening in the market, think of it this way. We had a bad day yesterday, right? All three of these stocks, the CQNS downrun stocks, dropped yesterday. We made a killing in the model on those three stocks, right? So what do? You don't take your profits, you short them again. You short them again. And then what do you do with the S&P 500? You short it again. Boom. Right at the open, right? And you're buying $5,000 worth of new stocks and you're spreading the wealth. See, the model wanted us to further diversify. So we have, 12 buys for $5,000. That's a lot of buys. It's a lot of spreading the money around, buying the cheaper stocks. So you have a hedge fund, right, with two different hedging strategies. We might even offer two hedging strategies. But for right now, I'm really trying to decide what to do. I like the hedge against the S&P 500. I like the hedge against the CQNS downruns. And I'm still struggling because you make a lot more money when you hedge against the downrun. I just don't know if over time that's going to be the case. So we might have to do a half and half hedge. I don't know. Just working on it, right? But so the model says, right, keep your hedge in place and add to your longs. So by adding to our longs, we did that. So now here's the psychological part. I knew the market was going to be falling today. I knew the market was going to have a bad day. It's at 37.49. It was like at 38.90 yesterday. Then it was like 37.90 when it closed. And now it's 37.48. And so market's down. I just got to be comfortable with buying when the market is down and selling when the market is up. It's a little counterintuitive, right? It's buying low and selling high. But when you manage money, you tend to want to buy high and sell low. Oh, take a loss, sell. Oh, stock went up, right? It's great, strong, buy more, right? So the model is forcing that kind of behavior. The model is also forcing a lot of discipline that says, if you're going to buy more longs, you got to buy more shorts. You have to have your shorts. Now, if you're not comfortable with 3 stocks short, you can always add a 4th. We could have added back Peloton, but we didn't. We just kept it with 3 because there's a lot of research. We've written papers on it, right? Like, don't over diversify your shorts. Your shorts should just be a few of them because they tend to counteract each other, right? So you don't want to diversify your shorts. So this is where we're at, okay? And so what I thought was interesting to share with you this morning, so we were taking a look at, so Jeff, how did your model do this morning, right? Here it is. This was the last snapshot I took. Every single stock is red. Red! Red. Murder. Red rum, right? And so when you look, though, we're going to have to take a look at this because I don't think it's quite as clear. Not the graphics, the message, right? So the first thing to look at is the S&P 500. This is, again, the last time we looked, which was like a few moments ago before we made the video. So right now you see the S&P 500 is at 375. So it was 375. So the S&P is down 0.6%. The 3 shorts we have, AMC, Snap, and EVBG, it looks like they're down about an average of 4%. Okay, so we have a hedge of 0.6 or we have a hedge of 4 negative. I like the 4 negative, by the way. I want the 4 negative hedge because I'm short that. So my shorts went up 4%. Great. Now we look at the stocks that we are long, and there's a lot of them. Now some of them, I can do this. I'll do it in a minute with live data, but for now, just to show you. So you look through and you see, you've got one stock that's down about 0, and another stock that's down about 7. And as I look, you're probably down 3.5 on average. 0 to 7, 3.5, right? Take the halfway point. But really, we can do a median. You're probably down 3%. So our shorts are down 4, our longs are down 3. We made 1%. We got to add high quality stocks like Tesla, like State Street, like Meta, like VMware, like Surgery Partners, like NVIDIA, like Lincoln National, like Carlyle Group. You get to add all of these different high quality names, and you're paying for the purchase through shorting what are basically, we used to call them dog stars, although I know that's a disrespectful name. And that's not bad. So at the end of the day, if I were to close trading right now, we would lose 3% on the stocks. We'd lose on the weighted hedge. We'd lose about 1.25, so we'd make about 1.25, 1.5. So we'd have been down 1.5% on our longs. That's not a great day, right? But if we short it, if we hedge it using the 3 dog stars, EVBG, Snap, and AMC, we'd actually be up 1% today. Now, a lot of cash went out the door, but we'd be up 1%, and then we see how tomorrow does, right? But already we're in a good space. So that's it. So I'm going to take a look now just at the live action. So it's just interesting because when you're managing one stock, when you're looking at one stock, when you're making a flyer on a stock, you focus myopically on one stock. But when you run a fund, you're looking at a tremendous amount of data about a tremendous amount of stocks. You don't really have time to go into all of them. And so here, I'll just hit the percent button, but that includes the shorts. And just to go across 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23, 24, 25, 26, 27. So between 13 and 14. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. So not an exact science. It looks like the overall portfolio of ours is down 2.7. We know that our shorts are down a heck of a lot more than that, so we made money today. Now, it's an ugly way to make money. It's ugly to make more money on your short hedges than you made on your longs, but that's the reason why you have to come to work every day and manage money, because you make a lot of money when the market falls, right? Stocks fall really fast. And so there you have it. So I don't know what else to talk about. I think this is going to be it. I could share with you for a friend. We do not have a position in a stock, but for a friend. CLF, Cleveland Cliffs. Cleveland Cliffs is a major steel manufacturer in the U.S. that also is a major miner of iron ore. And they got railway lines, and they got mines, and they got all that process. And I love the company, I love the mission, right? The stock is way down in the dumps here at 14.18. Now, I've seen the stock trade at $5, and I've seen it trade at 30. It just hurts. Good luck to anyone holding it. I am not going to talk about any stocks that we have a position in right now because that's not what this is about. And I just want to thank you guys for watching. So if you want to learn more about our portfolio or eventually even become a client of our portfolio, please check out chicagoquantum.com. As of this moment, we only sell our up and our down runs. We don't sell a smart volatility portfolio. But you could buy the runs, you can get a feel for what we're trying to do. You can actually trade off of that data as well for yourself. And especially the down run, you could find really great shorts. We found a way to isolate the real dogs in the market. High volatility, low movement. And then just take a look at our brochure. I have to tell you, you have to look at our brochure before you become a client. It is the law of the land. Please read the brochure, right? You learn all the terms and conditions, how much we charge, your benefits, what you get for the services, no surprises, no disappointments. And and then you can look. Sometimes we post pretty good data in our research tab. And in fact, we publish a lot of times, we'll publish our insights, the negative beta stocks, top dividend stocks. We have an ongoing piece of research on variance of the markets, which I find pretty interesting, right? Because when market variance goes up, I expect prices to go down. When variance starts to fall, I expect prices to start to go up. And so you hear a lot of people talk about, when we're at a bottom, you hear crickets in the market. There's no one trading. Nothing's happening. Stocks aren't moving. Well, duh, that's because variance is lower. When variance falls, when things get calm, people's expected return requirements drop. Look, if I'm not going to lose any money, I don't have to make a lot of money. But if I'm in a market now where the thing's crashing every other day, I got to make a fortune. And so I'm going to bid the price of stocks lower so that if I actually do buy a stock, like a Cleveland Cliffs, I only want to pay $14.20. I don't want to pay $30 for the stock, right? Because I want a chance for it to go up. I need to make 10, 20% for this thing. And so that's another piece of research that we do. It's behavioral, but it's important. All right, thank you very much for watching. If you want to reach us, I'll toss in my phone number here. It's Jeffrey Cohen, +1 312 555 7333. That's a cell. Comes here. Or you can shoot out an email, Jeffrey at quantum-usaci.com. We have a new email address, but we just haven't been using it. We pay for a new, very professional email address. But for now, just hit us here. If you want a job and you're close to Highland Park, Illinois, call me because we may be in a position soon to open up a position. If you like the markets and stocks and math and models and Python and data and trading and all that, I love it, right? So looking for people. And as we start to hire, we'll go grab an office somewhere in Highland Park, maybe buy a building. So, all right, you take care now. Thanks. Good luck in the markets. Bye-bye.